season. But we've got Steve Englander joining in on the show right now, and let's ask him about what he's making of the global market setup. Steve, hi, good morning. Great to have you on the show. Steve, what is it that you've read into from Kevin Walsh's statement, and does it seem like Fed perhaps will hold fire on rates for some more time to come, given their comfort on inflation?
Good morning, and pleasure to be on with you. And the answer is yes. I mean, our forecast was that they would be flat in 2026 back in January when the market was expecting a couple of cuts, and it's still that they're going to be flat. He talked a lot about productivity growth. And one element of that is that unit labor cost, which is the biggest driver of domestic price pressures, are very, very muted in the States. And with oil prices coming down, I think that that's what he meant by saying inflation risk is lower. You can make a strong case that they don't have to do anything much. That right now there's no big imbalance on the activity front. There's no big imbalance that's growing on the inflation. Whatever's happening is happening very slowly, and they can wait and see whether the structural forces, which seem to be very positive in the U.S., act to bring inflation down over time.
Yes, Steve. Is the market now pushing the rate hike further down the road, or maybe towards the end of the year instead of in the next Fed meet?
These are kind of nuances, so to speak. But there was a moment on Monday when it looked as if the market was flirting with the idea of pushing a hike into July. Then they backed away from it, and now it looks more towards the end of the year. But we're talking about a couple of basis points here and there. A year out from now, the market's pricing about 42, 43 basis points of hikes, which is kind of where it's been the last few weeks. But I'd say that the equity market response that we saw in the US today was largely in response to the sort of positive tone in the sense of inflation possibly being contained that Warsh conveyed at Sintra.
Steve, I wonder what you're making of the metals pack in general. We've seen quite a bit of cool-off, essentially, in global prices, not just gold, silver, but across the board. How are you looking at that cool-off, and sustainable, in your opinion? Despite everything playing out in the Middle East, the cool-off has been sharp.
I think the market was surprised by the run-up in real interest rates and nominal interest rates that we've seen. And I think they were long metals, long precious metals especially. And the positions were cut, and we saw prices coming off. But I don't think that this is the long-term destination for metals. There's still a lot of upward pressure in the world, and if equity prices continue to pick up, we think that certainly precious metals are going to rise, and with this being a supply shock, we don't think activity is so much endangered. So markets have to adjust. And the previous speaker was talking about higher interest rates because of stronger activity and higher demand. That's a good thing, not a bad thing. And I think the market is just maybe beginning to come to terms with that. So the answer is that this is a short-term reaction, but not necessarily where metals are going in the longer term.
Steve, how are you looking at the yen slide? It's breached the 162 mark and at nearly 4-decade low. And Japan has been trying to infuse dollars to support the currency. They did nearly $72 billion in April and May, and they're not able to manage the volatility in yen. Do you think there is going to be policy intervention that will come in, given the fact that currency intervention or dollar intervention is not working?
It doesn't look as if they want to. The most powerful intervention would be to push rates up faster than the market is expecting. And if anything, expectations have been going the other direction. So if you're not going to change policy and your only weapon is intervention, and the previous interventions have been middling in terms of their success. I'd say the market mood is very yen negative now. The market's divided between um, participants who are somewhat short yen and between participants who are waiting for intervention to knock dollar yen down a few big figures so that they can get short yen at a lower level. But there's no real story out there, no real narrative, especially when the dollar's going up against other currencies that, to give the yen much support. So I think for now it's in trouble. We'll have to see if there's any broader policy measures, but intervention by itself, especially isolated intervention, may not, may not be the ticket for durably stronger yen.
Right. Steve, great to speak with you. Thank you so much for your time
Thank you.
today. We'll let you go.